So, ठीक है. Good afternoon, friends. A very warm welcome to you all. Abhijit sir, a very warm welcome to you once again on Views platform. Though it is not a physical program, it's a VCM. So, you can only have a look with my folded hands. I welcome you, sir. I welcome Sunil Bajaj ji. Sir, welcome on Views. I also welcome our convener, joint convener Nitesh ji, executive member Pallavi, and all my dear friends who have joined in and who will be joining shortly. Today's topic is with respect to CARO and Schedule 2. And our learned speaker, I should not mention, Abhijit Bandyopadhyay sir is sitting in front of. So without wasting any further time, I once again welcome you, sir, and hand over the proceedings to Nitesh ji. Nitesh ji.
Thank you, Saroj ji. Welcome you, Abhijit sir, the senior chairman EIRC. 1998, I remember, he was the ICASA chairman. I was there in the board, and then he became the chairman in 99. And still, I have his blessings, and he has given me so much chance to work for the EIRC. So thank you. Thank you, Abhijit sir, for accepting our invitation for the program. That just to delegates, friends, the background material and the Excel sheets and everything you email tomorrow. By tomorrow evening you will get. So we will email to everybody. With this, thank you everyone, and welcome to Sunil Bajaj ji also.
Thank you, sir.
Thank you so much.
सर आप म्यूट पे, सरोज जी आप म्यूट पे आवाज नहीं.
Pallavi ji, I would request you to formally introduce Abhijit sir, though he does not require any introduction at all because he is well known. Please.
Yes. Welcome Abhijit sir. Sir, I would just give a brief introduction, as he doesn't need any kind of introduction. There is a long list of experience and qualifications and everything in regards to Abhijit sir. So out of his 33 years of experience, and just highlights some points. He is a FCA and DISA member of ICAI, and he has done his MCom from the Calcutta University. He is a past chairman also of Eastern India Council in 2000, and he has given his 16 years of experience as a council member in ICAI Institute. He is also a member of Taxation Committee of BCCI, and he has published many articles for ICAI journal, conferences and study circles, and on corporate governance, accounting and auditing. And he has also chaired as for the auditing assurance standard of ICIC for 6 years, from 2010 to 2016. He was also a member of sustainability group set up by CAG of India, and he is also chaired as a qualified audit report review committee set up by SEBI, and he's also a member of task force for ISA 540 set up by IASB of IFAC. So once again, I'm welcoming Abhijit Bandyopadhyay ji to hand over the session. Thank you.
So should I start?
Request everyone, sir, I would request everyone, please mute yourself other than the speaker.
Yes, sir, you can start.
Okay.
Yes, sir,
thank you, Pallavi, for nice introduction, and thank you, Saroj ji, Nitesh ji. As usual, views exchange always makes a difference, and I am really overwhelmed that when we talk about a subject, CARO and Schedule 3, which are of very immense importance today, because all the companies' accounts will be finalized in a period of next 2 to 3 months. And last Saturday only, I have addressed in a physical program organized by Views Exchange at Bengal Chamber Auditorium. And I was amazed to see that there was no single chair to sit. Some of the members were even standing. Quickly understanding the requirement of members, the appetite They have organized one second seminar on virtual mode. My compliments to Views Exchange and its team for that. Thank you very much. Nitish ji, you have been very kind enough to say that long back I was chairman ICASA. I remember that was the year when you presented a paper as a student, and this was a simply superb presentation, and there was a huge round of applause. I still remember I became chairman in the year 2000 after that. And today it is nice to see that you are attending same regional national level conference of CA students at Kalamundi today, and you are now past chairman of AISC. I think that's a long journey and it speaks volumes about you also. So thank you very much. I will just tell you the background of revision in the CARO and Schedule 3. You know that we audit companies, right? And companies, after we finish the audit, which is the Bible for audit procedure, standards on audit. We follow standards on audit guidance note issued by institute, because institute is still the authority on standards and guidance note. Even the NAFRA or the committees set up by Ministry of Corporate Affairs, the technical part lies with the Institute of Chartered Accountants of India. And we actually issue a report which goes to the shareholders as per the Companies Act. We talk about shareholders as the stakeholders, but believe me, there are many stakeholders in today's world. It is not the shareholders who has put in money and enjoying the ownership of a company. At this juncture, the vendors, the persons who are making transactions with the company, either supplying material or inventory, supplying services, or the customers who buys from the company, their interest, their financial interest, livelihood, everything is attached to the success or failure of the company. Similarly, the company owns a profit and pays taxes. So the government, through the direct and indirect tax mode, are directly linked to performance of each and every company. To talk about the shareholders, there are bondholders, debenture holders, and most importantly, the entities which finance, the fund, you know, the bankers, the financial institutions, they have their own stake in each and every company. Everybody would like to see that the company becomes a success story. And finally, of course, at capital market, if you invest in shares, if you invest in other company shares, it goes up and comes down with the performance of all the companies in the industry. It goes with the sentiment of the capital market. So all are stakeholders, and all would like to get the best information furnished by the company through its disclosure, through its profit and loss balance sheet and cash flow and other notes. Similarly, auditors come in between the readers and the preparers. Auditors would give a certification, and that would give a comfort to all the stakeholders, right? Let me give stress to the audit report as prescribed under SS 700 and 705 and 706. That's the main audit report. CARO itself is not a report. CARO is a questionnaire, and you have to state the fact based on your audit procedure. So for CARO, we don't do any audit procedure separately. CARO, we follow the audit procedure, take a note and answer to the questions. So in CARO, whether you mention something as positive, negative, what is adverse, what is qualification, one auditor has to apply his professional judgment. At this juncture, when there are many stakeholders and they rely heavily on the auditor's report and the management's accounts, there are irregularities, of course, in a system, and the regulators would like to make the regulations more and more stringent. Stakeholders are worried and anxious about the performance, but believe me, the regulators are more anxious, more worried, concerned about the performance, because not every time this would give a true and fair view. If that be so, then there would not have been any irregularity, any fraud, any scam. But there are, and they are more concerned about the fund utilized or procured by the companies, whether they are using it for the purpose they have taken the loan for, or they are investing in their own other subsidiaries, joint venture associates, or they are siphoning of the fund, they are misusing the fund. Earlier, when I was chairman WSB, I remember the CARO, earlier CARO was truncated post introduction of Companies Act 2013. And that time, Institute took a view that CARO may not be necessary because 2013 Companies Act talks about a lot of requirement of audit reporting, right, under section 143. So that we saw, in view of that, we said that CARO wouldn't be necessary. So I had attended a meeting with Ministry of Corporate Affairs, and there it was discussed and decided CARO would still be required in a shorter form, but it would focus on public interest. And what do you mean by public interest? Wherever there is a stake provided or put in by the public, be it customers, regulators, tax collectors, capital market, anybody. So they said that we need to focus on public interest and retain those clauses. And if you look at CARO 2016, there are only 16 clauses, simplified, but that talked about short-term fund used in long-term, fraud, siphoning or diversion of fund. Only those clauses were there. Whether you have the assets, whether you have control over the assets, inventory, whether the company has the fixed and current assets. Now, in last 4 years, I think the Companies Ministry and the regulators have understood that we need to ask more questions. So the result is the revised CARO 2020. Not only that CARO is needed, they have come back with a much more elaborated questionnaire in form of CARO 2020, wherein you will find 21 clauses, which is subdivided into 46 sub-clauses. And these 46 sub-clauses, 17 are new. We will take you through the CARO. Sunil will take you through Schedule 3, and I will also speak on CARO. Sunil will also take you through the CARO. You will see that 17 new clauses are absolutely new. This was never there, or some were there, but has come back in another form. There are 12 clauses where they have made changes, and the rest of the clauses they have continued. So it's believed that the ministry and the regulators want more and more information from the auditors. And then you see as many as 10 clauses are repeated in Schedule 3. Schedule 3 is revised. The Schedule 3 gives the format for financial statements, or generally accepted the financial statements, profit loss, cash flow, balance sheet, and other notes. That also has undergone revision. And if you look at the revision, when Sunil will speak, there would be 10 or 11 clauses of CARO they have extracted and put it in the form of disclosure. Why the requirement? The requirement is because now that the ministry want, not only auditors would report, let the management and the board of directors, who actually are the signatories, they should assume full responsibility of this certain information. The information, of course, are there embedded, and we'll discuss on that. But it's a clear requirement from the regulators that both management, board of directors, audit committee, and the auditors would have to come out with their disclosure. So there is a difference of opinion that will also come out. And once they read, they will get the picture from front and the back. So they want a 360-degree pictorial presentation of the financial affairs of the company. While there are more regulations, there would be definitely still loopholes. People will find out. But at this juncture, I would say this is a great work done by them, but it has given immense responsibility on the auditors and the preparers of financial statements in the form of revised Schedule 3 as well as revised CARO. So before I talk about specific clauses, I would request Sunil Bajaj to take us through Schedule 3, the new requirements, the revisions, and the purpose. And I would request also, I am supposed to speak on CARO, but I'm not well. So I'll request Sunil to take us to the main clauses. And definitely I'll come back and speak on certain specific matters. Sunil, I would also request you to speak at a very ground level when, not only that the changes, the impact, we would also like to know how do they implement. If there are certain implementation issues, Institute has given a guidance note. we have to follow that broadly, but going to the guidance note and understanding and implementation, there are difficulties because our members are from all sectors, all across the profession. Considering that, maybe you can more like discuss the major important clauses, but a little elaborately. So thank you very much. Sunil, I hand it over to you. It's all yours. Thank you.
Thank you, sir, for providing this opportunity, and to Nitesh ji for organizing such sessions to exchange the knowledge with various members on the topics of CARO and Schedule 3. So, is there someone will put up the slide, or should I share my screen?
Sir, you can share your screen and make you the co-host.
Okay. So we will start with the changes in the Schedule 3, the recent changes in the Schedule 3, and the changes. MC has amended the Schedule 3 with effect from 1st of April 2021, and these were notified on 24th of March 2021. Is my screen visible?
Ha, sir, visible.
Okay, okay, thank you. So first I will take you through the changes in the amendments to the Schedule 3 of the Companies Act, and then we will discuss the changes in the CARO as well. Further, while going through the amendments which are made in Schedule 3, we will also touch upon the changes which are aligned along with the CARO requirements. The MC has amended the Schedule 3 with effect the 1st April 2021, and it was notified on 24th March 2021 with an objective to increase transparency and provide additional disclosure. So, see the agenda for the session on Schedule 3. We'll see that the agenda has been broadly categorized as changes in balance sheet, changes in PL, and other changes in statement of changes in equity and other amendments. So the disclosure requirement under Schedule 3 has been broken into or divided into balance sheet, PL, SOCI, and as other amendments. So, as I mentioned, these are applicable from 1st of April 2021, and the changes has been prescribed to the Division 1 companies following AS, Division 2 companies following Ind AS, and Division 3 NBFCs. And these changes has been brought in to bring in more transparency and enhanced disclosures in the financial statement. And these amendments are aligned with the various reporting requirements with auditors reporting under the CARO. We, as we have seen that there has been means the CARO 2020 was deferred by 2 years. So now with the with Schedule 3 changes being effective, and now CARO 2020 is also effective from the same date. So basically, the theme is that company is required to make disclosures in the financial statements, and auditors are required to comment on that. And further, there are other specific changes also which has been specified in CARO 2020. So mostly like thus there is alignment between the company's auditor report and the company's reporting on the financial statement. So with the amendment in Schedule 3, it has been aligned with the changes which has been prescribed in company's auditor's report, CARO 2020. So now we will deep dive into the various changes which has been made in Schedule 3 disclosures requirement in the which has an impact on the balance sheet. This is a executive summary just to give an overview of what are the various changes which has been made and whether it is part of balance sheet or notes or PL, and whether similar changes are there in the CARO also. So I will take you through one by one all the changes which has been given for the purpose of balance sheet. Yeah, so the first changes, which is a very onerous change and a big change which has been brought in by MCA in Schedule 3, is the disclosures requirement of trade receivables. So earlier in the original requirement as per the Schedule 3, we used to give the disclosures as secured, unsecured, and credit impaired debtors. But now, like more extensive disclosures have been brought in by the Companies Act, by the MCA. So basically, first of all, the aging has to be given for all the receivables, and it has to be given into two categories: disputed and undisputed. So, so there are two things which we have to keep in mind. One is the aging, detail aging has to be given, and secondly, it has to be given on the basis of disputed and undisputed. So here we will spend a couple of minutes to discuss like what are the practical challenges noted while identifying whether a receivable is disputed or undisputed. Like the company has to gear up and have a policy to identify which are disputed and undisputed, and there should be proactive dialogues with the auditors, so that at the time of audit there will not be any should I approve or decline this? Okay. So, so with respect to the trade receivables, so regarding the disputed and undisputed trade receivables, so currently, like company may not have such policies of. So company may not have policies of identifying the disputed and undisputed debtors. So that policy has to be framed, and there should be proactive dialogues with the auditors, so that there should not be any issue arising at the time of audit. And further, uh, uh, we means further we need to also see that like earlier we only used to give secured, unsecured, and credit impaired. Now, like we have to also give the category of considered good, credit impaired as undisputed, and considered good, credit impaired as disputed. And this aging has to be given from the date of from the due date of payment. And so one of the challenges with respect to the policy, that is one problem. The other challenge which the company may face in is with respect to the aging. The ERP system has to be built in, so that the aging can be taken out directly from the system directly. Otherwise, it will be very difficult to do the aging as disputed and undisputed. So such configuration changes has to be made in the system by the management. So these are the two main issues or practical challenges which management may face at the time of complying with the disclosures of trade receivables aging, as well as disputed and undisputed. And for the auditors also, like if the management is showing a receivable as disputed trade receivables, then we also need to be more cautious whether such disputed trade receivables, whether adequate provision has been made in the financials or not against those disputed trade receivables. because the company may follow the expected credit loss model, and based on which the company may be providing the making the provisions against the receivables. But once the company gives disclosures of disputed trade receivables along with aging, then it is also on the auditor's part to check whether that expected credit loss model is able to provide a provision number which is adequate. Because if the company is showing something disputed, then it will need more provisions for such disputed receivables. And the other practical challenge is like when to say it is disputed and undisputed, because in many cases it happens that a customer has given a check, and that check has been bounced. So whether once it has been bounced, whether it is disputed dues or whether it is undisputed. So this kind of practical difficulties can be we can overcome. The management can overcome through this kind of practical difficulties by having a policy, robust policies in place, whereby they will identify under which circumstance and when it will trigger a trade receivable as disputed trade receivables. So this is with respect to trade receivables, and in case of unbilled and not due, so that also need to be disclosed separately, so that this balance along with aging tie up with the total balance which has been given in the schedule for the trade receivable. So implication, as I mentioned, while aging analysis for receivable would generally be carried out, specific information is in the required format may have to be tailored. System supports for information required for past 3-year information could be a challenge. Availability of the information directly from system in the required buckets for aging need to be reviewed, since no such disclosures is made previously. Important to capture due date, as aging is based on due date, and details of disputed receivables to be tracked and obtained from legal and sales team. So now again, in many cases, like this, one of the practical difficulties is to capture the aging from the due date, because if the system is not configured properly, and whenever there is a collection which has been made from the customers and it is adjusted against a specific receivables, so what happened that sometime in the system the latest date from which the collection was adjusted is being captured, and and when the management do the aging is done from the date when the collection was made against a particular receivables. So sometimes such practical difficulties are also being faced at the time of preparing the aging. So these are some of the difficulties and practical challenges with respect to the disputed and undisputed dues and trade receivables aging, and the enhanced disclosures which has been given in the which has been given as per the schedule 3. Now coming to the other disclosures with respect to trade payables. So with respect to trade payable also, like there was earlier, there was no requirement to give the aging of the trade payables in the bucket of less than 1 year, 1 to 2, 2 to 3, and more than 3 years. So this is a new disclosure which has to be given by the company, and the prescribed format is like, first we have to give MSME others, and here also like we have to identify which trade payables are disputed and which are which are disputed MSME and which are disputed others and which are undisputed. And further further with respect to trade payable also, like as we discussed with respect to trade receivable, similar policy has to be developed by the company, so that there is no last moment hiccups which arise with respect to the aging and with respect to the categorization of the trade payable as disputed and undisputed. And further, like this aging has to be given from the due date of payment, and in case the system is not configured to capture the due date of payment, then it has to be given from the date of transactions. So first priority is to give from the due date of payment, and second is from if it is not available, then the company can prepare it from the due date of from the date of transaction. So here again the practical difficulties being faced is whether the system is configured to provide aging report of the trade payable and as per the format which has been prescribed. Secondly, whether there is any policy in place to identify which are disputed and which are undisputed trade payables. And further, uh, so policy system configuration, these are two important aspects while we do the audit. And there are other aspects also which one has to keep in mind, like if a company has undisputed trade payables and which is in the age bucket of more than 1 to 2 years, 2 to 3 years, then it may raise question on the liquidity position of the company, because being undisputed and being overdue, it's generally it should not remain overdue beyond its repayment date. So under that circumstances, auditor need to be careful and skeptic, and they need to also evaluate the liquidity position of the company. If there are creditors in the age bracket of 1 to 2, 2 to 3 years, so careful evaluation has to be made while doing the aging of the trade payables also. So it is not so easy to like just to means do the aging and disclose, because lot of questions will arise if there will be balances in age bracket of 1 to 2 and 2 to 3 years, and these disclosures we are making as part of the financial statement, and it will be in public domain. So there are like third parties also who can challenge such disclosures, and who can also raise questions on the liquidity positions. It will also have an impact when the when the companies approach banks, lenders for borrowings. So that means such disclosures will have impact on their borrowing ability also. So these are some of the practical difficulties and challenges means with respect to this disclosures. And further, like as I mentioned that since we have to give the aging, so when we give aging for MSME creditors, so it will also have an impact on MSME creditors, because as per the MSME, like if it remain outstanding beyond a period of 45 days, and as per the MSME Act, the interest provision has to be made. So all this means informations need to be readily available, and the company has to evaluate like means careful evaluation has to be made before the aging is prepared. And further, like when we do the data crunching for the current period, we also need to be careful, because we have to do the similar aging disclosures for the previous year too. So the aging is not only for the current year, it has to be also be done for the previous year. So the company should be geared up. So and in advance they should be ready with the aging schedules for the previous years, and that will also be a starting point for them to do the evaluation of the aging of the trade payables. So this all these things we have discussed with respect to trade payables. Now moving to the one another disclosure with respect to capital work in progress and intangibles under development. So there were no disclosure, means aging requirement or disclosures which were made by the company with respect to capital work in progress and intangibles under development. So this is a vast disclosure which has been brought in through the changes in the Schedule 3 by MCA, and means it will lead to a lot of difficulties for the management also, because currently, like we only used to disclose the total amount which was lying as part of capital work in progress. So such analysis which was done by the management as part of their evaluation of each project, those were not coming out as part of the financial statement, but now those will come as part of as a disclosure in the financial statement. So the first disclosure with respect to the capital work in progress is the aging schedule. So aging has to be given for the projects which are in progress and projects temporarily suspended. So such disclosure will again means management as well as auditor has to be like need to be very careful, like for the management, if they disclose the aging of the uh, capital projects which are in progress, and if it is like 1 to 2 years or in a aging bracket of more than 3 years, then careful evaluation has to be made whether it is in progress or these are temporarily suspended projects. So that is one piece of information which they have to be ready with. So again, this way, this schedule, this aging schedule is means there are a lot of practical difficulties in preparing this aging schedule, because first would be that the system would not be geared up to give the aging of the capital work in progress, because it there was no such disclosure requirement in the erstwhile schedule 3. Secondly, like so the management has to like there is a need to configure the ERP, update the ERP which is used for the purpose of accounting and purpose of like generation of reports. So that is one piece that the company has to gear up. Now, the second is like this aging is to be determined from which date. So it has to be determined from the date of its initial recognition on the balance sheet date. So it may happen that a project may have different assets category, and then those asset like being recognized in the balance sheet at a different point in time. So they will fall under different age buckets. So that will also be there. Temporary suspension of a project, which is a necessary part of the process of getting an asset ready for intended use. The CV related to such projects should continue to be presented under projects in progress, and evaluation of projects in progress and temporarily suspended should be done at each reporting date, and any change during or after the reporting will not change the classification of the assets of project for the purpose of above disclosure. Now, this will throw challenges on the company's management also, such disclosure, because if first of all, if a project was supposed to be completed within a period of 1 year, and if it is lying like for more than 1 year, 2 years, 3 years, then a careful evaluation has to be made by the management that why such projects are lying for more than 1 year, 2 years age bucket. And for the auditor also, like we also need to be very careful and skeptic, because there may be projects which need to be charged off or impaired. So from once this disclosures will come in place, auditor has to be need to be very careful with respect to the provisioning requirement with respect to capital work in progress. So that is one part. Now, apart from the aging, one has to also give the disclosure relating to the timeline by which it will be completed. So that is another disclosure which has to be given. And further, one of the disclosure is that if the capital work in progress is overdue and it has exceeded its original plan cost, then such disclosure has to be given. Now the question comes how do we evaluate whether it has exceeded its original plan cost? Because in many cases we will find that there are subsequent revisions which are happening to the original plan. So basically, hello, can you please put on mute?
Yes, sir. Please start. Please go ahead.
Yeah, sorry.
Sorry.
So here, what I means the practical challenge is how do we evaluate whether it has exceeded its original plan cost or not? Because there are revisions in the original plan. So guidance has been given in the guidance note which has been issued by MCA. It says that we have to compare it with the original plan, and we need to see that if there are any changes which has been made to the original plan, whether it's only an small changes or a change in some estimate which has been done, but original plan remain intact, and whether there is a totally change in the original plan. So this evaluation has to be done when we evaluate whether it has exceeded its original plan cost or not. So that is one important thing which we need to consider while giving the disclosure relating to the capital work in progress, its original plan, and whether it has whether it is overdue and whether it is exceeded its original plan cost. So what are the implications for the company? Teams would need to verify if aging can be extracted from the system. Disclosure of temporarily suspended project would trigger impairment analysis, though not mandated. Depending upon the quantum of relevance, explanation for overdue or overrun or suspended projects may become necessary. Information required: aging report as per dates on which assets are put in CWIP, along with amounts, are required to be reported for each project as per the aging bucket. Completion schedule, expected completion date of the assets, and expected cost to be incurred forming part of CWIP would need to be needed. So this is also like a very onerous disclosure, and like a lot of effort has to be put in before the management means go ahead with this disclosure, because there has to be a policy also. Further, it will also have an impact on the capitalization of the interest borrowing cost. So like if we have a project in the age bucket of 2 years, 3 years, and so it will have an impact like on whether we should capitalize the borrowing cost or not, because if originally it was supposed to be completed within 1 year, then there may be we need to carefully examine whether we can capitalize the borrowing cost. It may be because of the projects remaining suspended for some time. And secondly, if projects are overdue, and sometime it happens that it is overdue, and it may also need a careful evaluation whether any impairment provision is required, or if it exceed its cost. So evaluation has to be done to examine whether any revenue expenditures are not being capitalized as part of CWIP. So these disclosures will lead to will raise a lot of questions when we perform our audit procedures, because means earlier, like, we used to take the CWIP schedules and do our audit procedures, but once we disclose such information in the financial statement, it it is our responsibility, and it is on the auditor also to ask such questions which I have mentioned right now. So means management also has to be geared up, as well as auditor has to be geared up, and as I said, they have to also evaluate their audit procedures, whether they have to examine whether there is any need to change their audit procedures for the capital work in progress line item. Now, moving to the next item, which is on title deeds of the immovable properties. So earlier, like means as per the Ind AS 16, we used to check whether the property is in the name of the company or not, and whether the company has a title deed of whether the title deed is in the name of the company, and whether any charge or has been created against that property. So all these disclosures were required as per schedule, as per Ind AS 16, and which continues to be there. And along with that, there has been certain more disclosure requirement which has been brought in by Schedule 3. So the title deeds of the immovable property not held in the name of the company is a new disclosure requirement under the head additional regulatory information, which is required to be provided in notes to balance sheet. The details to be given in the prescribed format would include details of title deed held in the name of the company, held since date, reasons for not being held in the name of the company, etc. So this is a illustrative. This table is for illustrative purpose, and the company may change the format based on the requirement. Now, what implication this disclosure will have on both on the management as well as on the auditors? So suppose sometime in many company, because of certain restructuring, or because of the demerger, or any kind of restructuring. So what happens that apart from movable properties, some immovable properties also come and sit into the company's balance sheet because of such restructuring. And sometime what happens that the other company does not means there is a time gap in changing the title deed in the name of the company, or the company has purchased from some other entity or a group entity, and they have not got it in the name of the another entity. So what will happen, such disclosure will lead to this disclosure will help in tracking such properties which are not in the name of the company, and a continuous disclosure repetition of such disclosure over the period may also raise questions whether the company should continue to record this uh, asset in their books, because if the title deed is not in the name of the company, then it will raise such question. So all these disclosures means have means means they have a lot of implications for the management as well as for the auditors, because auditor has to challenge the management stand assumptions which they have taken. They may go ahead with the title deed not in the name of the company. So in that circumstances, auditor has to challenge whether this asset can be continue to be in the books or not. So that is one important thing which need to be taken care. And apart from that, uh, means this disclosure will also helps the lender also to know upfront that whether the title deed is in the name of the company or not, because many a times the bank give loan against the immovable property as a security against those loans. So it will have an implication while the means when the company will go for borrowings. So that at that time it will have an implication on the company, because if the title deed is not in the company, the bank may not give the loan to the company. So that is one challenge which is thrown up because of the requirement of this disclosure. Further, like as I mentioned, that this Schedule 3 changes are to align with the changes which has been given in the CARO. So in one of the clauses of the CARO, the auditor has to report whether the title deed is in the name of the company or not. So so from this disclosure means the management will disclose whether it is in the name of the company or not, and auditor will give their opinion based on the disclosures made by the management. So this has also an implication on the CARO reporting. Now coming to the other changes which has been made in the Schedule 3, which is with respect to the disclosures of shares held by the promoter. So there was no such disclosures earlier given in the Schedule 3. Earlier we used to only disclose shareholding of the shareholders holding more than 5% of the shares in the under the heading equity share capital. But now this amendment has been brought in by MCA, wherein the shareholding of all the promoter has to be given in the notes of the share capital, along with the number of shares and the percentage of shares, and any change in the percentage holding as compared to the previous year. And so this is another change which has been brought in by the MCA. So as we know, for all listed entity, they have to disclose their shareholding of the promoter and promoter group. So earlier they used to disclose. So currently all the listed company disclose the shareholding pattern as per the requirement of SEBI LODR. So this is apart from the disclosure which they have been doing as per the SEBI LODR. So this is they have to bring in this information in the financial statement. And in the one thing we should note that in the as per the SEBI LODR, the company used to disclose for promoter and promoter group, but here in this case the company will only disclose for the shares held by the promoter. So this is an additional requirement which has been brought in by the MCA. Now moving to the next. Yeah. So this is also an important disclosure which has been introduced by MCA in Schedule 3, which is with respect to loan to promoter, directors, KMP, and related parties. So before I move to before we move to this, I will just pause here, and I will move back to our discussion on immovable properties. So there is another change which has been suggested by another disclosure requirement which has been brought in by MCA in the Schedule 3, which is with respect to the revaluation of PP. So if a company has gone ahead with any revaluation of the PP, and if it is not from the registered valuer, then an adequate disclosure has to be given in the financial statement that this revaluation has been done, but it was not carried out by a registered valuer. Now we will come back to this disclosure on loan to promoter, directors, KMPs, and related parties. So where the company makes any loans, advances to promoter, director, KMP, and other related party jointly or severally, and any such loan or advance in the nature of loan has been given. So this disclosure has to be made based on the type of the borrower and the amount of the loan or advance in the nature of loan which is outstanding, and the percentage of the total loan and advance in the nature of loan which is outstanding. So this is completely a new disclosure which has been given in the Schedule 3. Further, similar requirement is also there in clause 3F of the CARO 2020. So their auditor is required to report on loan to promoters. So this again, this disclosure requirement which has been given in Schedule 3, it has been aligned with the reporting requirement audit in the auditor's report on CARO. And now, like, means as we see that in while auditing the related party transactions, and we what we find that, like, these terms and conditions, interest rates, so these things are not mentioned clearly, or it is not like uh, means there we will not find any agreement, or if agreement is in place, then it is not detailed one. So with this disclosure coming in place, management has to again, like, revisit their agreement with the related party, has to see what are the repayment terms, interest which they have to charge on those loan. And further, like, if there are, like, many implications, because here we have to mention whether it has any specific terms or not. So without specifying any terms or period of repayment, if the company has given any loan, so since this will again come and be part of the notes to the disclosure to the financial statement, so management has to be very careful while entering into an loan agreement with the group companies or KMPs, and they cannot, like, go ahead with lending the money without any specifying terms. So means all these things now will be means there will be a stoppage on all these transactions, or means where there is no specifying specific terms. And similarly, we have to also report on this item in the CARO 2020. And further, we need to be, like, means when this disclosure is forming part of the financial statement, we also need to be careful with similar disclosures relating to related party transactions and outstanding balances being disclosed separately in the financial statement. So we need to see that in both the places these are aligned. There should not be any differences in the disclosures. Yeah, these are some of the changes, classification changes, which has been made in the balance sheet. One is with respect to the current maturities of the long-term borrowings. So earlier it was disclosed under the heading other financial liabilities. Now it has to be disclosed under the head borrowing. So by making such changes, there will be no ambiguity in computing various ratios such as debt equity ratios. So earlier there was a doubt whether to include the current maturities of long-term borrowing while computing the debt equity ratio. So now such a doubt has been removed by bringing in such changes in the disclosures. On the other changes which has been brought in through the Schedule 3 is the change in the disclosure of security deposit. So security deposit was earlier shown under the head loan. Now it has been classified under the head other financial assets. So any security deposit which are not in the nature of loan. So earlier everything was sitting under the head loan. Now it will be disclosed under the head other financial assets. On the other disclosure requirement changes which has been made, one of the changes with respect to the lease liability. So there was a perennial discussion or debate which was going on with respect to the lease liabilities, whether this lease liability, the current and the non-current portion, whether it has to be disclosed under the head other financial liability or borrowing. So currently the practice was to show it. Both the practice were prevalent. Some of them were showing it as other financial liability, current and non-current, and in some cases it was shown under the head borrowings. Now this doubt or debate has been means it will go away with the changes which has been suggested amendment which has been made to the Schedule 3. Now it has to be disclosed as current, non-current financial liability on the face of the balance sheet. One more change which has been brought in was with respect to rounding of criteria. So with respect to that, earlier it was based on the turnover, and now it is based on the total income of less than or more than 100 crores. Moving next. So now we will discuss the changes which may have an impact on the in the profit and loss statement. So one of the important amendment which has been made to Schedule 3 is with respect to the undisclosed income. So if a company give details of any transaction not recorded in the books that has been surrendered or disclosed as income during the year in the tax assessment under the Income Tax Act, and whether the previously unrecorded income and related asset has been properly recorded in the books of account during the year. So here means one need to be careful, like if any amount which has been added back by the income tax authorities as a disallowance, so such amount should not be considered as undisclosed income. So that need to be taken care of. And again, this similar disclosure is there, which whereby the auditor, as part of clause 3(8) of the CARO, has to means report in their CARO 2020, and this information may be obtained from the review of the tax assessment orders and relevant to consider restatement implication if pertaining to earlier years. Reporting under this clause implies to undisclosed income that the company must have voluntarily admitted to, and not applicable when addition is made by income tax authorities and disputed by the companies for such addition. So this is a disclosure format which the company has to give in case they have in case there is any undisclosed income. CSR, there are like certain small changes which has been brought in through the amendment to the Schedule 3, where the company is covered under 135 of the Companies Act. Like if it is, there are certain criterias. It should have profit and in the last 3 preceding financial year, and 2% of the same has to be like they have to contribute towards corporate social responsibility purpose. So the following shall be disclosed under the CSR activity: amount required to be spent, amount of expenditure incurred, shortfall at the end, total of the previous year shortfall, reason for shortfall, nature of CSR activity, detail of related party transaction, because sometime it may happen that a trust has been formed which is controlled by the company in relation to CSR expenditure. So if it fall under the related party definition as per Ind AS 24, then it has to be disclosed. And where a provision is made with respect to liability incurred by entering into contractual obligation, the movement of such provision. Moving next, with respect to the other changes which has been introduced by Schedule 3, which is with respect to the utilization of the borrowed fund and share premium. So again, here it is like in case of IPO and all or right issue, means there are separate accounts which are being maintained where the collection is made, where the company received the money, and from there the company can track means exactly where the money has been utilized. So money being fungible, it is difficult to identify like where it has been utilized. So utilization of the borrowed fund is again a challenging means aspect, and it is like the company has to gear up and has means they need to have system in place which can capture such informations. So this is again like a onerous means disclosure on the management side to means have the system in place and to identify where the money has been utilized, so borrowed fund. So the company shall disclose if it has made any disbursement of the fund by way of advance loan, investment, 20% entity being ultimate beneficiary. So again, it has means there is a change in Rule 11E of the Companies Act. So means this disclosure will help in reporting requirement of the auditors in their report as per Rule 11E. So if the company has to disclose whether any borrowed fund has been utilized, means which has been channeled through any other entity for the benefit of any ultimate beneficiary. So that examination has to be done by the management. Means how means they can track such a fund flow, and further this will this why MCA has brought in such a disclosure requirement, because there has been like a lot of money laundering or siphoning of the money which has been borrowed by the company and not utilized for the purpose it was borrowed. So such disclosure will help in identifying such issues in the system. So that is one of the purpose of bringing in such a disclosure requirement as per the Schedule 3. And further, uh, for the auditor also to report as per Rule 11E, this disclosure made by the management will help them in forming their audit opinion. And so this is one of the important aspect. So basically, tracking of money trail can be a difficult task and will need involvement of senior management to identify such transactions. And this cover transactions that do not take place directly between the company and ultimate beneficiary, but are camouflaged by including a pass-through entity in order to hide the ultimate beneficiary. Reporting obligation include inbound as well as outbound. So whether we are like receiving the money for passing it on to the other entity, ultimate beneficiary, or we are giving it to intermediary for passing it on to the ultimate beneficiary. So both leg of the transaction has to be captured and disclosed as per the requirement of Schedule 3. Where the company has not used the borrowed from banks and financiers for specific purpose for which it was taken at the balance sheet date, the company shall disclose the details where they have been utilized. This reporting will also be done by auditors as per clause 3(9)(c) of the CARO's report. The specific tracking for utilization of the fund to match its purpose it was taken. So that is a implication and the information required. The next disclosure is with respect to detail of default if the company is declared as a willful defaulter. So this is an additional disclosure requirement as per the Schedule 3, where the company has to give a disclosure in the financial statement whether they have been declared as a willful defaulter by the banks or financial institutions. So this disclosure has a lot of implications, like it will have firstly the implication on the liquidity position and on the going concern ability of the entity, because if the company is unable to repay its debt on time and it has been declared as a willful defaulter, then it will lead to questions on its operations as well as liquidity positions. So this disclosure uh, will have an impact on the company's operations too, because the vendors may not be ready to give the to supply the material to the company, means on a credit basis. So that is one important aspect of it. Similarly, this also has a means auditor also has to report as per their CARO 2020 that if the company has been declared as a willful defaulter. And as I mentioned, it will also have an implication on the going concern assumptions. And if it triggers that the entity is not a going concern or there are going concern issues, then it will have an implication on the auditor's report also, because now we have to like give separate means we have to report separately in the auditor's report if there is a material uncertainty on the going concern ability of the company. So that is also one important thing which one has to keep in mind. So this is so this reporting requirement also has a lot of implications. Now, one of the important changes, or one of the important requirement of the Schedule 3 is the disclosures of the various ratios in the notes to accounts. So earlier, such disclosures was not mandatory, and it was not there as per the erstwhile Schedule 3. So management used to report such disclosure in the director MD&A section of the director's report, and further for listed entities where the debts are listed, they have to disclose the various ratios which has been prescribed in SEBI LODR. So the company has to give the disclosures of the ratios. So for listed entity, debts are listed, then they have to give disclosure of the various ratios. Similarly, if under the MD&A section, the company management used to disclose the various ratio. Now it will form part of the notes to account of the FS. So the major challenge here is that one need to align the definition in all the places, like aligning the definition in the FS as well as aligning in MD&A and the SEBI LODR requirement. So there should not be any discrepancies or different stands should not be taken by the management while disclosing the ratios in different places. So a careful evaluation has to be done, and if there is any like ambiguity or there is any different stand being taken at different place, so it should be like in all the places it means a similar ratio or similar disclosure should be made. So it should be aligned in all the places. Now the other important requirement which is there as per the Schedule 3 is that if there is any change in the ratio by more than 25% as compared to the preceding period, then an explanation has to be given by the management that what the reason for such means the reason for such change in ratio by more than 25%. So that is an additional requirement which has to be given, and the company should explain the item included in the numerator and denominator for the purpose of computing the above ratios. So these are some of the changes, means the ratios which has been introduced by the Schedule 3. Implication, as I said, that management may generally be performing similar analysis for internal management and monitoring purpose. Explanation for variance beyond 25% has to be well articulated. Means it need to be explained in a way that the user of the financial statement understand why the variation is, and further the disclosure of the formulas for computing will enable easy comparison between the two companies. And information required is the company to revisit details submitted to management for review in ACM deck MIS to check whether it include all ratios required to be disclosed. And so these are some of the things, and this is how the disclosure has to be made in the FS. So this is a format which has been prescribed. Now, this is one of the important disclosure requirement as per Schedule 3. So this is with respect to the struck off companies. So this is more to plug the fraudulent transactions with the companies which are no longer in operations or which has been struck off by the MCA. So this will help in means tracking the transactions made by the company with struck off companies and the reason for doing such transaction with such struck off companies. So and further it has been the schedule, the guidance note has defined that struck off companies mean companies which has been under section 2848 and 560 of the Companies Act shall disclose the detail as mentioned in the prescribed format. So what are the implication of this disclosure? One is that to plug the fraudulent transactions with the companies which are no longer in existence, because lot of monies and has been extracted and money laundering happens by doing transactions with such companies. So with in order to stop such transactions, MCA has brought in such changes in Schedule 3. So that is important disclosure. Further, it is again very onerous disclosure on the company part. Like how do they identify which companies are struck off and which are not struck off companies? So that is one important thing, because means the list of the companies with whom the company is doing transaction will be a huge list. So it will be very difficult to track those companies whether it is struck off or not, because it may also happen that the company has done some transaction with a struck off company before it was actually struck off. So basically, this disclosure, again, management need to gear up their system to monitor the status of the companies, whether it is struck off or not. So means there is a information which is published by MCA in their website, where they give the list of the struck off companies. So the management has to go through those lists and means compare it with their vendors details, and in case they identify that the vendor has been struck off, so then they should also identify and update their system, so that means there means all in any kind of fraudulent transactions or siphoning of the money can be avoided by identifying the struck off companies. So this is also one of the important changes which has been suggested by the which has been given in the Schedule 3 to the Companies Act. So this bring to a conclusion on my presentation on the changes which has been made in Schedule 3 to the Companies Act. I am happy to take questions, if any, from any of the members, and post that I will take you through the changes in the CARO 2020.
Yeah, Sunil, thank you very much. I think the presentation was well covered. There are many questions, but would you like to say a few words about the Division 1, Division 2, and Division 3? Because Division 1 applies only to AS cases.
Yes.
Division 2 applies to Ind AS. Now, in the audience, I suppose there are many companies or auditors of many companies wherein only AS would apply. So, for example, trade receivable, the slide you have covered, is applicable to Division 2 Ind AS. For AS, the second and fifth category may not be there. So, would you like to say a few words on the division classification?
Yeah, sure, sir. I will cover that too in quickly. So most of the disclosures which I have mentioned for Division 2 are also applicable to Division 1. So I will highlight the changes which are not applicable to Division 1, or any additional requirement is there for Division 1. So with respect to rounding off, it is applicable to Division 1 entities also. With respect to Division 1, means there is a additional change with respect to the format of the not format, basically under the asset category, non-current asset, PP and intangible assets. As earlier it was PP and intangible, now it is PP is separately and intangible assets are shown separately. So there are two categories under PP. The other additional disclosure, as I mentioned, with respect to shareholding of promoter, it is there in Division 1 also. On the current maturities of the long-term borrowing, which has to be disclosed under the head borrowing. So this is also there in as part of Division 1. With respect to trade payables, the aging has to be the aging which we discussed for Division 2 is similarly applicable for Division 1, with MSME other disputed and undisputed. With respect to with respect to the Division 1, any change due to devaluation, if it has been carried by the company, and if the change is more than 10%, then additional disclosure has to be given in the financial statement, and the company also has to disclose whether it has been carried out by the registered valuer. Security deposit, again, as I mentioned, again, it will be omitted from long-term loans and advances, and it will be given under other non-current assets. Utilization of the borrowings, this has to be disclosed as per division 1 also. Trade receivables, the aging is with respect to considered good and considered doubtful. So there it was like considered good, credit impaired. So with respect to division 1, since AS is applicable to those entities, so in that case it is undisputed, considered good and considered doubtful. And here when we were discussing AS division 2 entities, it was considered good and considered doubtful. 1 minute, I will say exactly what it was. So there it was considered good whether there is a significant increase in credit risk and credit impaired. So this was the 3 disclosure when we discussed relating to division 2 entities. And similarly for disputed also, we have to say considered good, significant increase in credit risk and credit impaired. But in case of division 1 entities, we only have to disclose considered good and considered doubtful. So this is because of the AS and NDS difference. Apart from that, title deeds of immovable property not held in the name of the company, this is also applicable for division 1 entities. Then loans and advances given to promoter, director, KMPs and related party. So these are also need to be disclosed as part of as per division 1 entities. Capital work in progress, aging schedules and project which has exceeded its plan cost and which is overdue. So that disclosure remain valid for division 1 entities also. Benami properties held in the name of the companies, that is also to be disclosed as per division 1 entities. Then enhanced disclosure for borrowings from banks on the basis of security of the current assets. So this also has to be disclosed as per the division 1 entities, and this also has a implication on the auditor's CARO report. Then willful defaulter reporting also has to be done by the division 1 entities, and stock of companies as per section 248 and 560 of the Companies Act, that also need to be disclosed by the division 1 entities. And the ratios which we discussed, that also have to be disclosed along with reason for more than 25%. And we have not discussed one changes, but it is applicable to both division 1, division 2 entities, which is with respect to the number of layers prescribed under section 287. So if companies has not complied with the number of layer prescribed, 2 layers of the company can invest up to through 2 layers of the entities. So that disclosure has to be done by both the division 1, division 2 entities. And utilization of the borrowed fund and share premium, it is also equally applicable for division 1 entities. Apart from that, like on the face of the PL, we used to give revenue from operation, other income, and total as total revenue. So it is now changed to total income. Additional disclosure under notes to profit and loss, revenue from operations, it is relevant in case of section 8 companies only, grant or donation received. So under revenue from operation, grant or donation received has to be disclosed. And undisclosed income remains similar to what we discussed in with respect to division 2 entities. CSR disclosure is again similar to what we have discussed with respect to division 1 entity. Again, another disclosure which we have not discussed in division 2 is with respect to transactions in cryptocurrencies or virtual currencies. So this, if any company has traded or invested in crypto or virtual currencies, so that has to be disclosed. And if its impact on profit and loss, and amount of currency held as on the reporting date. So this disclosure has to be made for both Division 1 and Division 2 entities. So apart from the trade receivable thing, all other disclosures remain the same for both Division 1 and Division 2 entities. With that, I complete my presentation on Schedule 3 for Division 1 and Division 2. Sir, you are on mute.
Thank you once again, Sunil. We have many questions, but I believe you have covered many of the clauses of CARO as well, because these are all common. Schedule 3 disclosure has been added now, which was also there in revised CARO. Would you like to take us through some of the applications and CARO clauses which you have not spoken on? If you can cover it in next 10 minutes, then we can have 20 minutes question answer.
Sure, sir. So I'm not going into the background and applicability. It is like from 1st April 2021, and the CARO means applicability of the CARO to the companies. It is to all the companies except for one person, small companies, banking company registered for charitable purpose, insurance, private company not being subsidiary or holding, gross receipt or revenue not exceeding 10 crores and paid up share capital not more than 1 crore, and borrowing not exceeding 1 crore at any time during the financial year. So these are some of the applicability requirements. So I will take you through some of the important changes. The one which we have discussed as part of Schedule 3, we will not discuss it again. So we have discussed all the requirement of PP, except for like earlier means the physical verification has to be done for PP. Now it will also cover intangible asset. Further, we have to also for title deeds we have to also disclose for cases which are on leases. So these are two changes which has been made, and the most important change which is with respect to the revaluation of the PP. So if there is any revaluation of the PP and more than 10% of the total value has been changed, so that has been inserted as per clause D of CARO in clause 1. So this is a new clause. Benami transaction we have already covered while we discussed Schedule 3. So if there is any Benami transactions means for holding any Benami property, so the auditor also has to report in their CARO. So that is one change. Deed, old property, lost reports, reporting on revaluation. This I have already said that this revaluation has to be disclosed. This is a new change. Benami property is a new change. Reporting on inventory means it is there are no major changes which has been done, or except for this paragraph where this new subclause has been inserted, which requires auditor to report whether the quarterly return or statement filed by the company with the banks or financial institutions are in agreement with the books of account. So earlier we never used to report any such. There was no such reporting requirement in the auditor's report. Now we have to report whether means any borrowings where the working capital sanctioned to the company is more than 5 crores and the company and it is against the current asset of the company and the company is filing quarterly returns. So we have to examine whether the numbers which has been reported in those quarterly returns are whether it reconcile with the statements, with the books of accounts or not, and if there is any discrepancy, then we have to report in the CARO 2020 in the CARO report. So disclosure we have discussed. 5 working capital made in excess of 5 crores. With respect to the reporting on loans, investment, guarantee securities, or advance in the nature of loan. So basically, this clause was there. So now the the changes which has been made is with respect to the reporting requirement on the adequacy of the terms and conditions requiring the investment made, securities given, or guarantees provided, and the advances in the nature of the loan. Additional reporting in terms of amount of loans or advances provided to group outstanding at the balance sheet date, and further means are there any loan or guarantee which has been given, whether the loan which has been given or advance in the nature of loan given either repayable on demand or without specifying any terms or period of repayments. So this we covered when we discussed Schedule 3. So similarly, auditor also has to give their opinion based on the disclosure which has been made in the FS. So this has been aligned with the Schedule 3 changes also. So this is same additional requirement on the amount of the loan security given. So this is same. Yeah, there is reporting on deposits. So deposits also, like we used to disclose in earlier erstwhile CARO also. So means we have to evaluate, means the company has to file DPT 3 and 4. So we need to see whether any deemed deposit has been disclosed by the management in that statement, and whether it will have a reporting implication in the CARO 2020. Statutory dues, there is no change except they have included goods and service tax, and so there is no change. With respect to reporting on use of money raised through issue of own shares, so there were reporting under 2 different clauses. Now it has been combined, and in case of preferential allotment of private placements of shares or convertible, auditor is also required to verify and report of compliance of Section 62 of the Section 62 reporting requirement on repayment and usage of the borrowings. So this is this we have covered along with the Schedule 3, where we discuss on the utilization of the borrowing. So if the management disclose that they have not utilized the borrowing for the purpose it was borrowed, then auditor also has to report in the CARO 2020. New subclause has been inserted which require additional reporting whether the company is declared as a willful defaulter. That we have already covered through Schedule 3, whether the term loan were applied for the purpose for which the loan was obtained, and usage of the long-term and the short-term funds. Detail of the fund borrowed by holding for the purpose of discharging obligation of the group entities. So this is an important clause which has been introduced, which has been given in CARO 2020, because there are many instances and cases where the fund has been borrowed by the parent for the purpose of meeting the obligation of the group companies or the subsidiaries. So means it may not be clearly mentioned in the sanction letter or documents or in the agreement with the lenders, but through the usage pattern, means one can say that this has not been utilized for the purpose it was borrowed. And so this is an important and onerous means disclosures and the reporting requirement. Then reporting on default we have discussed, willful defaulter we have discussed, term loan not applied for the purpose we have discussed, fund borrowed by holding for purpose of discharging obligation we have discussed. Reporting on fraud, there is no change with respect to reporting on fraud. All the fraud on the company is required. New subclause has been inserted where reporting requirement made by the auditor to central government under 143(12) has been inserted. And this is one change, consideration of whistleblower complaints received by the company. So this is also like we have to report whether any whistleblower complaint has been received. Earlier, we are not used to report under for whistleblower complaints, but now it has come under the ambit of the auditors to report any complaint which has been received through whistleblower mechanism. So now, like every listed company has a like they have a whistleblower policy in place, which is required as per the SEBI LODR. Further, like we also as an auditor has to perform various audit procedures to check like whether those IDs on which a person can means whether on the IDs which has been disclosed on the website means are those in working conditions or not, and we have to send we have to perform various audit procedure to assess whether those IDs are working, and we have to then connect with the company secretary and the owner of that ID to understand whether any complaint has been received, whether any whistleblower complaint has been received by the company during the year. So again, like for auditors, a lot of audit considerations and audit procedure has to be performed to report under this whistleblower complaints. Reporting of fraud we have discussed 143.12. Nidhi company, this is same reporting on default in payment or deposit thereon by Nidhi company, calculations, determination of default, event of default, whether as per RBI. 45 IA. In 45 IA, there has been certain changes which has been brought in. Whether the NBFC or the housing finance activities are done after taking certification of registration from RBI, fulfillment of classification criteria led by RBI for core investment companies. So many a times we come across a structure where one of the companies is a holding company, holdco, which hold investment in the other group entities. So as per RBI has laid down the principle of core investment company, they have defined they have laid down the principle when a company will be a core investment company. So there is a circular on the RBI website, and which we have to like follow in order to evaluate whether a company is core investment company. And in case there is a company which is a core investment company, so in that case we have to report in CARO 2020. Further, like there is another change with respect to the number of core investment companies in the group to which the companies belong. So, and here the group definition is very wide, and so it may happen that the company may means a group, a promoter may have 3-4 verticals, and so those verticals may be like entities under common control, but not like directly linked to each other. But for the purpose of this CIC reporting, those 3-4 verticals will be considered as a group, and if there are CICs in either of the verticals, then it has to be reported by the auditors. So this is another change. Undisclosed, unrecorded income we have already discussed. Internal audit, like means reporting whether the company has an internal audit system commensurate with the size, and whether the reports on internal audit for the period under audit were considered by statutory auditors or not. So this is again a new requirement, whether we have considered those report of internal auditor. So this we have to check. Cash losses, this is a new clause which has been inserted. So whether the company has incurred any cash losses in the financial year and in immediately preceding financial year, and if so, state the amount of such cash losses. So this also have an implication on the liquidity position and on the going concern ability of the entity. If the company continues to incur financial losses, cash losses, then auditor, apart from like reporting under CARO, they also need to evaluate on the going concern assumption of the management. Auditor resignation, this is an important clause, and this is a new clause which has been introduced in CARO 2020. So if there is any resignation of statutory auditor during the year, if so, whether the statutory auditor has taken into consideration issue, objections, or consideration concern raised by the outgoing auditors. So this is the new clause. Yeah, this is a clause which is with respect to the going concern assessment made by the management. So basically on the basis of the financial ratio is aging and expected date of realization of the financial assets and payment of financial liability, the auditor acknowledged of the board of directors and management plan whether the auditor is of the opinion that no material uncertainty exists as on the date of the auditor's report. So like earlier, what used to happen, we used to report under in the main audit report under the heading material uncertainty on going concern assumption. So now if we are reporting there in the main audit report, then we have to also report under the CARO 2020 if there is any material uncertainty on the going concern assumption of the entity. So this is a new clause. So here also, like lot of audit procedures we have to perform. So this has been given in this. Then reporting on CSR compliance. This was not there in the earlier CARO 2020, earlier CARO 2016. Now it has been introduced under CARO 2020 as a clause 20. And the last clause which has been introduced is clause 21, which is with respect to the negative reporting or any adverse reporting made by the component auditors in the CARO report of the in the CARO report of the components. Then the parent auditor has to report, has to bring out such negative or the adverse reporting which has been made by the component auditor, and it has in the consolidated auditor's report, they have to this clause 21 has to be reported by the parent auditor. So the parent auditor has to compile all the adverse or the negative reporting given by the component auditors, which include the holding company. So this bring to an end to the changes, the major changes which has been made in Schedule 3 in the CARO 2020, apart from the changes which we discussed along with Schedule 3.
Okay, thank you, Sunil. Now coming back to, we have around 12 minutes. We have got many questions on the chat box. I would request, I would ask the organizers, should we go on answering the questions on the chat box, or you want the speakers to speak and raise their questions?
I think sir, it's better to answer the question as a lot of queries are there.
Yeah. Now I'll cover that, but before that, two more points on the CARO. What Sunil has mentioned, that, as I said, 17 clauses are new. One or two you need to understand while reporting that, first of all, when you talk about loans taken for example, working capital loan taken against the security of current assets from banks and FIs, there is a need for quarterly returns to be submitted to the bank, and it says that the auditors will have to now verify whether they are submitting those returns, and if there are different figures shown in the statement as well in comparison to the books of accounts. So earlier this was not there. Here the threshold in CARO is rupees 5 crore and above. So it says sanction limit, right? But similar provision in the Schedule 3 is also there. But incidentally, there is no threshold mentioned in the Schedule 3. So in Schedule 3, there are questions normally raised whether the 5 crore threshold would apply. Answer is Schedule 3, there is no threshold, but CARO, of course, auditors will have to look at the sanction limit 5 crore and above and report whether quarterly returns are submitted, and if yes, then whether the figures would tally the books of accounts. Material uncertainty, remember, whenever, as I said in the beginning, the CARO is not a separate audit report. CARO is an annexer to the audit report. CARO is a questionnaire which the auditors, after completing his process of audit, is answering. So whatever we write in the CARO cannot be inconsistent with the main report. Now, there is a clause on material uncertainty to settle the obligations, that is the payment, whether the company has enough liquidity, enough assets to recover the money and then pay off the debts, the obligations, the liabilities. Here one needs to understand this is directly linked with the going concern concept. SA 570, please read, there are enough guidance. And it basically talks about, I mean, it is now on the auditors and management both to see whether there is a material uncertainty or significant doubt on the company to run their business as a going concern. The guidance note says the company has to establish that it has the necessary fund to run the business at least for 12 months. Otherwise, there would be a significant doubt. There are triggers, but at the same time, remember, mere a company making a loss or cash loss or making loss for consecutive years may not have a cast aspersion on the companies running as a going concern. There could be temporary sickness, there could be temporary drawbacks. For example, during COVID time, many people thought that many of the company's entities are going sick and there will be no going concern issues. So one has to see whether the materials are available. That can have an impact. One can see whether the company has the fund to procure raw material and inventory, whether the company has enough capacity to run business, whether there is a customer of the products, whether there are funds, banks are ready to fund or they have rejected or refused to fund. So it's a wholesome, impact. So everybody has to see the significant factors concerning or impacting the going concern issue. And when you answer to this, CARO also consider that at this juncture, whether the company is in a fix, is not in a position to have fund to meet its liability and obligation. So that's a very onerous responsibility on the auditors. One has to see. Another difficulty which we have faced, and many of the auditors said that they are facing, at the last, the MCA has introduced and said that in case of the clause 21 applies to only consolidated financial statements, wherein the auditors will have to necessarily consider CARO reporting by all the components. Now, if your company has say 10 components and 10 components are not necessarily audited by you, if you have audited, you are the same auditor, there is no question. But if there are different auditors and they have given their component observations, one has to compile, see, and then cover in their main report. There is no choice. The professional judgment is not given as per the guidance note. You have to basically reiterate that. But question is, it is to be reported only when it is adverse or qualification report, or adverse report or qualifications. Now, which one is adverse and which one is qualification? For example, if undisputed tax dues not remaining unpaid, and if the auditors will have to report that this disputed part of the tax, this is an XR, or these are the details that company has not yet paid. Or for example, willful defaulter or undisclosed income, the auditors will have to state. Okay, that's the statement on CARO. Many companies would take a stand that it is a statement of fact and it is not an adverse. It's only answering to the question. So it may not be an adverse or qualified report issued by the component. So accordingly, it cannot be taken to the consolidated financial statements, CARO, the main group company, the main company's CARO report. So there is a fix. There is a question of applying professional judgment. If you look at the guidance note on revised CARO, it says clearly that it is left to the choice of the group auditor. They have to apply their mind and see which one is adverse and which one is qualification. If they feel that it is mere a statement of fact, they may not carry it forward. But if they feel this is an adverse report or qualification, they can carry it forward to the CARO of the main company. So I thought I'll mention a few points which I thought would be important. There are many questions, but I'm saying Pawan Kumar Agarwal and Shoibal Gangopadhyay have raised hands. So I'll give the chance to Pawan Kumar Agarwal first. Pawanji, if you can raise your points.
Thank you, sir. Good afternoon, sir.
Good
बहुत दिन के
afternoon.
बाद आपसे बात हो रहा है.
Yes, we need to meet frequently.
सरकारी एक मेरा 2 पॉइंट था. सर इसमें अपने को राउंडिंग अप करना पड़ रहा है बैलेंस शीट में डिपेंडिंग ऑन द नेट प्रॉफिट. तो अगर मेरा बैलेंस शीट राउंड अप में बन रहा है, देन अगर कल मुझे इनकम टैक्स डिपार्टमेंट या जीएसटी डिपार्टमेंट बैलेंस शीट कॉपी मांगता है, then which copy should I give to the department, then income tax or to GST department? Because MCA में जो रिपोर्ट जाएगा वो राउंडिंग अप जाएगा और इनकम टैक्स में जब एड्रेस 6 फिल अप करेंगे वहाँ पूरा फिगर देना है. So how to solve this problem?
You have asked a question to Sunil. Sunil, could you answer to that?
Yeah, sir. Basically, here the question is with respect to rounding off. So, if the company prepares the financial using the rounding off norms given in the given as per the Schedule 3. So here there is a practical difficulty with respect to like filing the same statement with GST or the other department, which is in full figures, full numbers. So basically, see the requirement as per the Schedule 3 is mandatory to round off the financials. So one has to prepare the financial in full figures only, and then a final round off has to be done to the face of the balance sheet and the notes to accounts, because in order to comply with the requirement of Schedule 3. So what we would suggest that the company should prepare the financial in full figure only, and then once that is done, then they should put the rounding of formula in the financials as per the means based on the total income, whatever is applicable to the company's nearest lakh rupees or thousand of crores, whatever. So first it should be prepared in full rupees and then should be converted into rounding off so that both the purpose can be solved.
Should I
That
need to sign 2 report or should I need to sign 1 report?
Signing will be done on the one report which is rounded off, and along with which the auditor will give their auditor's report. But now means with respect to the financial which has to be given to the GST department or others, there if they can accept the management accounts, then it is fine. But or means along with management accounts, you can also share the audited financials for them to like consider the numbers or the numbers which they want to like check from the financial statement. So
Okay, sir. Abhishek sir, can I give a suggestion? मैं आपका व्यू चाहूँगा. Can I make the statement landscape and can I give both the figure, मैंने rounding up and full final
No.
figure. And
You
can I
cannot,
sign
you
it?
cannot.
वो diversion हो जाएगा Schedule 3 से.
Yeah, Schedule 3 requires you to round off now. So they have defined which company to round off to what, whether 1,000 lakhs and all. In case you have to give detailed information in tax, according to me, you can prepare your detailed information and annex to that. But signing under Companies Act would be the rounded off financials. That's my take.
So second issue only. Sir, अभी से बहुत सी कंपनी ने शेयर प्रीमियम आया था and they have gone for the BDI scheme. And BDI scheme में कंपनी ने पेमेंट भी कर दिया, डिस्क्लोज भी कर दिया. तो अभी जो शेयर प्रीमियम खड़ा है उस कंपनी के अकाउंट में, तो हाउ टू डिस्क्लोज द सेम एंड शुड आई टेक द शेयर कैपिटल इन एज ए फॉर्मेटिव कैपिटल?
Sunil, did you get the question?
so not exactly, but actually
फिर से बोलता हूँ सर, जैसे मेरा शेयर कैपिटल 10 लाख है, शेयर प्रीमियम इज 1 करोड़. मैंने डिपार्टमेंट ने मेरे ऊपर एडबैक कर दिया एंड मैंने जब स्कीम निकला है बीडीआई स्कीम डिपार्टमेंट का, आई हैव गॉन इन द स्कीम कंपनी और वहाँ पर उसने पेमेंट करके शेयर प्रीमियम को अपना कैपिटल मान लिया है. नाउ एज ऑडिटर हाउ शुड आई रिपोर्ट द इन माय ऑडिट कारो रिपोर्ट एंड शुड आई टेक द शेयर प्रीमियम और अदर जो बोगस शेयर कैपिटल है, शुड कैन आई से इट इज माइन?
This I think we need to get back on this query. I now I have understood your query, whereby like the share premium was added back by the department, and it is now shown as part of the share capital. So whether there is any reporting implication in auditor's report, I need to check that.
Thank you, sir.
Okay. Shoaibal, you would like to speak, or I have many questions from you. I can take up those questions.
Yes, those are the questions of it only. And
Okay.
I would like to one more question is there. What is the definition of return on investment here? Is it return on capital invested by the company or return on investments made by the company?
Yeah, before I answer to your questions, or I ask Sunil to answer questions, I have around noted, while Sunil was speaking on CARO, I have noted around 25 questions on the chat box. But let me tell you, I will not answer. I have, Sarojji, I have decided not to answer at least 18 questions out of 25. I am very sorry to see the level of questions with all due regards. Some of the questions are very basic, and they should not have actually asked questions like this. This is frustrating. And I don't know who is POCO M2. I got many questions from POCO M2 and Shoaibal Gangopadhyay. May I know the name of POCO M2? Now, Shoaibal's question for all of you, he is asking a question, return on investment, whether this is return on the capital employed by the company or the company's hands. Suppose they have invested money and there is a return. Which one actually is asking for in the schedule 3 to give a disclosure? I don't have to answer the question. I will not ask even Sunil to answer the question. I want the answer from Shoaibal. He should go read and come back to me. What do you mean by return on investment? I mean, all these days you have read, you have heard about return on investment. Is it my investments return? Is that a relevance of that? Or the company has to give a return on its paid up capital? I mean, capital employed.
In appendix of guidance note, they have given one formula: net income from investment divided, net return from investment divided by different classes of investment. That is making the confusion.
Okay, so then I'll have to go back to the guidance. Sunil, you have any?
Yeah. So I would like to clarify. This is the return on investment made by the company. So any return generated on those investment which has been made by the company, that has to be disclosed in the ratios of the Schedule 3.
So that means MCA has a different idea, and maybe they have discussed with institute and they have given a guidance note. If that be so, but generally, if you ask me return on investment, it will always be the return on capital employed.
That was also my idea.
Yes, that's a good point. I'll raise it to the institute to see what exactly prompted to write in the guidance note. But basic question, I mean, normally we should not ask. For example, one question is there. Difference between cost model and revaluation model. This question, I don't think there is anything to do with revised Schedule 3 or revised CARO. Cost model or revaluation model are very well discussed in the standard, in the guidance everywhere. Or even when we studied CA, we know what is cost model, revaluation model. Whenever Ind AS was introduced, there was a lot of discussion. So please go back to the study and read something. MSME company, suppose they don't disclose. A question has come on MSME. If the company, the MSME in their agreement with the company do not disclose that they are MSME, how do they treat that in the disclosure? The company should have a mechanism to ask for whether you are MSME or not, and it is the responsibility of the other company to say, yes, I am MSME. If they do not, and if they don't mention, how on this earth the first company which is making transactions would understand the other company's MSME? There is no, list or schedule. So they would be treated as non-MSME. Small and OPC Schedule 3 applicable. Remember, Schedule 3 is applicable for all companies. In CARO, their applicability, there is a confusion because when it started, it wrote small CARO would not apply to small companies and any private company which is not a holding or subsidiary of a public company, and the revenue would not exceed 10 crore and etc. Paid up capital and loans. But later on, the definition of small companies is revised. So a lot of questions are raised to me if small companies is now defined as having a revenue of 20 crore, but private company are up to 10 crore are only exempted. So what will happen to those companies, private companies not being small, holding or subsidiary having a revenue of 15 crore? Now, I understand guidance note is very clear. Institute has said that any of the clauses, if you get exempted, you are exempted. So now that small company would cover up to 20 crore and all the companies up to 20 crore, if they satisfy the definition of small company, CARO would not apply. Land valuation, there are many questions on land valuation. If there is, Soival, you have raised a question, if part of the land is not valued or something, I believe on a when there is a land booked in the books of accounts shown as a fixed assets, the land has to be transferred to the company by means of acquisition, purchase, merger, demerger or something. Then only they are showing, right? The question is, when you look at the original document, that is not in the name of the company. Now, in case there is a land of 10 acre and the company has taken 5 acre, the part of the land still lies with them, or maybe the 5 acre which they have acquired are still in the name of the erstwhile promoter, erstwhile owner. That is only reportable. And how do they know the cost? The cost booked by the company will depend on the cost paid to the original owner, or at the time of reconstruction, merger, demerger, or acquisition, there has to be a valuation based on which the transaction will take place. And in the hands of buyer, that is the cost. So whatever is paid, that will be cost. So valuation would be necessary. Otherwise, how do they know?
Abhijit, just a minute. It is a case of nationalization, and 2 or 3 or 4 mills were taken together, and in the schedules, total land has been given. But say there is 10 bighas of land. Within this 3 bighas and 7 bighas, 3 bighas have is in the name of erstwhile farm, and balance in the name of the present. So how to segregate? It's given in totality. No separation has been done like that at the time of nationalization.
It's a typical specific case, but my take would be, out of 10 acres, suppose 3 acres have been acquired by the national government paying some money. And if you have bought it for say 1 crore and 3 crore, they have taken 3 acres, they have taken and given a compensation of 40 lakh. Normal concept says that it should be proportionately distributed, the cost. And the difference of cost and the compensation received would be treated as profit or loss. That's what my take. Sunil, you have a different view?
No, sir. I have means I don't have any different take. Means it should be allocated based on the price paid for
That's
that.
right. Now there are questions like, if there are no deeds available. See, Companies Act says that auditors will have to report if there is no deed or deed in the name of somebody else. It is not that you have to, it's a question of reversal or you have to throw it out of the books. As of now, CARO, the intention is that whether the actually land is in the name of the company. If it is not there, you report as of now. That is what I was saying, that if the auditor says that this land is not in the name of somebody, whether that's a adverse report or qualification, or it's a matter of statement of fact. So there is a debate and you have to apply professional judgment. But however, as of now, it should be only reportable by the auditors and the company. Sensitive information about WIP and intangible, how does a company disclose? There is a question. Yes, this is debatable. There are many areas where people feel, and every fora they are raising questions that this will be sensitive. But as of now, MCA has come out with this as a matter of disclosure and audit report. One has to talk about the aging and if it is cost overrun or time overrun, one has to commit. And that's where MCA wants a management and a board of directors to come out with responsibility and say in public when they are going to. And this has arisen because of many companies have taken fat loans from banks against capitalization of, for example, plant, machinery. In power sector, it has happened. And 3,000, 4,000 crores of rupees have gone into, deep sea, only because suddenly there was a fall in demand, and or there was a crisis of fuel, that is coal and all. So many of the companies did not want to go ahead with the project and just stopped for years together. Whose loss is this? The bank has put in money. The promoter's money is only a negligible amount. So that is where I think this has arisen, that if that is the case, the promoters will have to give necessarily a disclosure when they are supposed to complete and what's their responsibility. No, if there is no loan to KMPs or promoters, whether still you have to give a disclosure, you just disclose that there are no loans to promoters or KMPs. Loan against current asset by FI Bank, I have already covered that. If it is CARO, then 5 crore above sanction limit. If there is no threshold in Schedule 3. CSR ongoing and suspended. What is the difference? Somebody has asked a question. So CSR ongoing is the CSR, like any project may take more than 1 year's time to complete. So in normal course, it's on track, but it takes little more time. So it's an ongoing. But some of the projects where you have spent money, but the company felt or the CSR authority felt that they will not go ahead, or temporarily they have put it under suspension. Both are reportable. So there is a difference between ongoing and suspended project. Formula for the ratios. Now I understand the guidance note has given the formula for ratios. I have not seen the latest the part of it. But if you think there is the disclosure, otherwise even the formula for the ratios are well defined under the glossary of terms and many guidance notes and application guidance of issued by the institute. Name of startup companies, where do you get? NCA site has a portion where you can follow. You can get names of all the startup companies. Trade receivables, someone has asked a question, whether if doubtful debts, how do they disclose? I think Sunil has covered in both Division 1 and Division 2, AS and INDES. It talks about disputed, undisputed, and
considered good and considered
good, unsecured, and considered bad. That considered bad is bad and doubtful debt. If it is a new company, then definitely the outstanding more than 1 year, 2 year would be nil. MSME I have covered. Division 1, Sunil has covered after I told him, yes. Draft financial statements in Excel, I think it is there with the organizer. They will give you. Benami property, one sec. Benami, I lost the question. Benami, someone has asked a question. Benami property, if it is there in the name of the company, then it is not a Benami transaction, right?
Correct.
Benami would mean that you own something which is not in your name. So I don't know whether the question is properly asked. I think I have covered almost all the relevant questions. If someone has still a question, you can ask, but we are already 14 minutes beyond schedule. So if organizers permit, can we take more questions, or we'll call it a day to here? Pallavi?
Yes, sir. Yes, sir.
Okay. So I think yes, sir, yes, sir would mean that we need to close the session now. If they have further questions, they are free to write to me or Sunil through Views Exchange. We will answer to all the questions. Thank you so much for the opportunity. Thank you. Thanks, Sunil.
Thanks.
Thank you
to everyone.
Thank you so much, Abhijit sir and Sunil ji, for such elaborate discussions on CARO and each and every schedules related to it. And there are a lot of questions which has been handled by Sunil ji and Abhijit sir. And I think a lot of queries has been cleared and confusions has been cleared from the participants who has attended. I think this was a very enlightening and discussion. I think it was a very enlightening seminar. And I would thank you, Abhijit sir and Sunil ji, for giving us the precious time and making this seminar as a success. And I would thank Saroj ji also for organizing. this session and all the participants for attending this session. I think we should wrap up the session. Thank you, sir.
Thank you. Thank you so much.
Thank you so much.
Thanks to all of you.
Thank you, sir,
Thank you.
for sparing time for all of us and enriching us. Thank you, sir.
Thank you.
Thank
So
you.
we'll close the session and we'll drop.
Yes, sir.